Hello, everyone. So you think you want to buy gold? Good. But before you do, take a moment. In this video, we will cover 7 common mistakes beginners make when investing in gold and how to avoid them. Watch until the end for a simple strategy that can save you time and frustration when you're ready to buy. Music mistake 1, expecting gold to deliver rapid gains. Many first-time investors treat gold as a speculative asset. They expect it to deliver quick returns, often in response to headlines or short-term market moves. This is misguided. Gold is not designed to generate fast profits. It is not a high-growth investment. It is a long-term store of value, an asset that preserves purchasing power over decades, not weeks. But more importantly, gold represents something that most investors overlook: true diversification. Many believe they have a diversified portfolio because they hold a mix of equities, bonds, property, or even other alternative assets. Yet, if every one of those investments is held within the traditional financial system, how diversified are they really? Gold allows you to step outside that system entirely. It is not a promise made by a financial institution. It is not dependent on monetary policy, regulatory frameworks, or digital infrastructure. When you begin to think of gold in this way, you stop worrying about its short-term price fluctuations. A conversation shifts from potential gains to protection and long-term preservation of wealth. Avoid this mistake by recognizing that gold is not meant to behave like other investments. Its purpose is not to generate returns quickly, but instead to provide stability and resilience when other assets falter. Mistake 2, confusing physical gold with paper gold. There are many ways to gain exposure to the gold market: ETFs, mining shares, digital platforms, and sovereign bonds among them. But these are not substitutes for physical gold. At its core, this is about proximity to the gold, and not just in terms of geography. It is about how many layers sit between you and the asset itself. With physical allocated gold, you own the metal directly. There is no intermediary standing between you and the ownership of your gold. With paper gold, situation is very different. You may only hold a piece of paper confirming a stake in a fund that happens to hold gold somewhere, or you may own shares in a mining company, which is an entirely different proposition altogether. In that case, you're exposed to the company's operational risks, regulatory challenges, and market sentiment. You're not buying gold itself. You're buying a claim on a business that may or may not succeed in extracting and selling it. The further removed you are from direct ownership, the greater the risk of delays, restrictions, and losses. So avoid this mistake by ensuring that at least part of your gold holdings are in physical form, properly allocated, audited, and ideally stored in a politically stable jurisdiction. Proximity matters, ownership matters. Mistake 3, attempting to time the market, waiting for the perfect moment. Buy gold is a tempting idea, but often a futile one. Gold tends not to reward market timing. Its cycles are longer, and short-term price moves are rarely predictable. New investors frequently delay purchases in hope of a better entry point, only to remain sidelined indefinitely. So avoid this mistake by adopting a disciplined, gradual approach. Dollar cost average and accumulate gold in small amounts over time to help smooth out price volatility and remove the need to predict market moves. Mistake 4, understanding bullion basics. Many beginners wrongly assume that all physical gold is the same, but in practice, not all gold products are suitable for investment. Bullion refers to investment-grade gold and silver, typically in the form of coins and bars, produced by sovereign mints and LBMA-approved refiners. These products are widely recognized for their purity and weight, making them easy to trade globally. Collectible coins, commemorative pieces, and jewelry often carry higher premiums and can be very difficult to sell at fair value. So avoid this mistake by sticking to simple bullion coins and bars, buying from reputable bullion dealers. Focus on quality, recognizability, ease of resale. Mistake 5, underestimating storage and security costs. Many new investors focus on the purchase of gold, but neglect the question of storage. The most important decision for those seeking to invest in and own precious metals is how and where to store their bullion. This may mean keeping a modest quantity at home or in highly liquid, ultra-secure vaults, while storing the majority in a secure international facility located in a financially and politically stable jurisdiction. Goldcore has partners with the likes of Loomis and Brink's, world leaders in precious metal storage, to provide fully insured storage options for our clients across jurisdictions, including Switzerland and Singapore. So avoid this mistake by factoring storage into your plans from the outset. Safe, diversified storage is not just about security. It is a key part of sound wealth preservation. Mistake 6, believe in gold is unaffordable. Many investors wrongly assume that gold is beyond their reach, believing that one must commit thousands and thousands of pounds or euros or dollars to begin with. But this is not the case. Gold can be purchased in smaller amounts, fractional bars and coins, as well as regular savings plans such as Goldco's Gold Saver account, which allows investors to build a position gradually. Entry points can start with as little as $100 and $10 or 100 pounds a month. And this makes gold far more accessible than many realize. The more relevant question here is whether you can afford not to own gold. Gold is one of the few assets that sits entirely outside of the traditional financial system. It has consistently preserved value through economic downturns and monetary crises, and it also allows for full direct ownership, unlike most financial products. So including physical gold in your portfolio is less about wealth and more about prudent diversification, as it plays a role that cash, equities, and bonds cannot replicate. So avoid this mistake by focusing on what you can afford to invest and by recognizing that the true value of gold lies in its role as a long-term financial insurance. And finally, mistake 7, overlooking tax and pension opportunities. Many investors overlook the tax implications of their gold and silver purchases. Some bullion coins and bars, such as Britannia and sovereigns, are exempt from capital gains tax for UK investors, making them more attractive than other products. Holding tax-efficient products can significantly improve long-term outcomes. Additionally, in certain cases, gold can be held within pensions or retirement accounts depending on local regulations. And of course, this can offer further tax advantages and allow gold to play a former role in your retirement planning. So avoid this mistake by researching the tax rules that apply to different types of gold and silver products in your jurisdiction, and consider whether you can hold gold within your pension or broader financial strategy to maximize its benefits. So here's my final thought. Gold requires patience and perspective. Gold's price might be the thing that's captured your attention, but really its real value lies elsewhere. It is a deliberate long-term hedge against financial and political uncertainty. It is not exciting and it is not designed to be. Gold simply does what it has always done. It protects wealth. If you approach it with patience and discipline, it will serve its purpose. And as promised, here is a simple strategy worth considering. Before you buy, decide exactly how much of your portfolio you wish to allocate to gold and silver. Stick to that target regardless of the price fluctuations, and this removes emotion from the process and ensures that gold and silver play their proper role as quiet anchors of financial stability. If you found this helpful, subscribe to Goldcore TV or pass it on to a friend who is also thinking about investing in bullion